So finally, financials. Here's how I recommend you think about your financials. So you want to be sending out a monthly report on the financials of your company. We're saying here that we had April 2024 actuals versus April 2024 budget. So budget versus actuals, sometimes it's useful. A lot of times what's more useful is just looking at April 2024 actuals versus March 2024 actuals so people can actually see the change in trend. Because if your budget wasn't very accurate, then sometimes it's just sort of noise. But in either of these scenarios, here's how I like to kind of compare the months. So you have your difference, and then I like to say like percent. So I would just take this number and divide it by this number. So, and then here you can take this number divided by this number to just look at the sort of percent change. And so here's how to kind of do this. And we're just going to walk through the numbers so you can get a sense of sort of what they mean. And then we can just copy this over to the other column. So let's say we're really tracking everything against our budget. And so we say, okay, the actuals, we beat our budget. It was 67,000. So we beat our budget by 8,000. In terms of on the expense side, you do want budgets, especially on the expense side, to try to control your costs. So we're saying that we're basically right on budget in terms of cost of sales, maybe slightly over, but very close. And then gross margin, we outperformed by $8,000 because of the increase in revenue. In terms of operating expenses, we were generally under, so we were under by about $3,000. So that's good news. And so operating income outperformed on the gross margin, outperformed on the expense side. But one thing is that your operating income doesn't reflect your cash flow, because if you're capitalizing software development and things like this, it doesn't really flow through your income statement in the same way that it's hitting your bank account. And so you always want to look to your cash flow statement, and you'll see that your operating income in April was negative 28,000, but your actual cash burn was negative 36,000. So just make sure you're watching out to understand the difference between your burn rate and your negative operating income. So if we just look at kind of month over month actuals, we could also use this and say, growth was 22%. We know growth was 22%. In this scenario, actually our gross margin increased by quite a bit. We got a little bit of a higher percent on the gross margin, increased by 24%. Then we have our operating expenses were down month over month on increased revenue. So improvement in operating income, improvement in burn rate. So these are a good way to sort of track your metrics and then decide, what you're going to say about them. So here's like a couple ideas on what you could say. So let's say outperformed budget by 14%. 14% on revenue, and we grew revenue 22% month over month. So we know that. What else? Improved gross margin slightly from 87% to 88% from operating leverage. So that's here. You can see we're getting basically more margin. And so operating leverage, you'll hear this term sometimes. Operating leverage basically means more revenue / profits without increasing costs. So you have a team in place and you can continue to drive more revenue. So you're seeing flat COGS, but you're able to actually drive more revenue through the same hosting, support, credit card fees, COGS. And so that's called leverage. You're getting operating leverage out of a fixed cost base and then improved efficiency on top of it. Okay, what else? You have reduced overall OPEX by 2%. You can see here, month over month, driven by mostly by this. So that's consultants, driven by cutting redundant consultant. And then you can say operating loss narrowed from 41K in March to 28K in April. So that's a 32% reduction in operating loss. So you can see that here. And we already talked about our burn rate, so I don't think we need to cover that again.